This time, let's discuss Chinese banks. The activity of bank lending serves as a barometer for the vitality or decline of a country's economy. I'd like you to take a look at this article, which covers recent developments in Chinese bank lending. Specifically, it reports the figures for November 2024, which fell significantly short of expectations. Currently, interest rates in China are being guided lower, making it easier for borrowers to access loans. However, as we've seen in Japan in the past, and even today, given Japan's low interest rates, reducing rates doesn't always stimulate active lending. Lowering interest rates often signals an economic downturn, discouraging businesses from borrowing to start new ventures or expand existing ones. As a result, the current situation in China mirrors this pattern, where rate cuts don't necessarily lead to economic revitalization. Banks fundamentally operate by lending money and earning interest. Their business thrives on issuing loans. However, when lending slows down, banks turn to alternatives like investing in bonds, selling financial products, or marketing structured instruments to wealthy clients. Still, the traditional model involves extending loans to businesses, fostering their growth, and earning interest income in the process. When this core activity stagnates, it directly affects the bank's performance. This discussion leads us to examine the salaries of Chinese bank employees. While complete data for the entire year isn't available yet, detailed figures for the first half of the year reveal some insights into the banking sector's state through the lens of employee compensation. Among the numerous banks in China, there are 6 major state-owned banks that represent the country's banking industry: Industrial and Commercial Bank of China, ICBC, China Construction Bank, CCB, Agricultural Bank of China, ABC, Bank of China, BOC, Postal Savings Bank of China, PSBC, and Bank of Communications, BOCOM. Many people who have lived or worked in China likely have accounts with one of these banks. On average, salaries at these banks aren't particularly high compared to private banks in China. For instance, average monthly salaries at these state-owned banks hover around 20,000 yuan, equivalent to approximately 400,000 yen. From a Japanese perspective, this may seem reasonable, but within China, these salaries are among the highest for salaried workers. However, private banks offer even higher compensation. The highest paying bank in the first half of this year was China Merchants Bank, with average monthly salaries exceeding 50,000 yuan, over 1 million yen, translating to annual incomes above 10 million yen. Despite these figures, the situation is far from ideal. This year, over 40,000 employees across 42 listed banks in Shanghai were laid off, with the 6 major state-owned banks accounting for over 20,000 of these redundancies. For example, ICBC alone let go of more than 10,000 employees, while BOC was the only major bank to increase its workforce, adding nearly 2,000 employees. The total wage bill across these banks has decreased by nearly 700 million yuan, approximately 14 billion yen. While average monthly incomes at some banks may exceed 1 million yen, salaries at 41 of the 42 listed banks have fallen by over 70%. Although some employees continue to earn relatively high wages, many face severe financial challenges due to significant pay cuts. The root cause of these issues lies in the stagnation of the banking sector's core business. As I mentioned earlier, bank lending is closely tied to the overall economic activity of a country. For instance, if a company's products are selling well, it may borrow to expand production facilities. Conversely, if sales are poor, companies are reluctant to borrow. Moreover, the reported slight increase in total loans doesn't indicate a rise in demand for new funds but rather reflects businesses borrowing to repay existing loans with added interest. This cycle inflates lending figures without genuinely reflecting economic growth. China's banking sector also faces severe risks due to unresolved problems in the real estate market, such as oversupply, massive debt, and stalled construction projects. Many loans extended for real estate projects have become non-performing assets. To maintain appearances, banks classify these as healthy assets, but the reality is much grimmer. If they were properly categorized as bad debts, it could jeopardize the bank's operations. It's widely believed that the Chinese Communist Party is deliberately avoiding a full-scale cleanup of non-performing assets to prevent catastrophic fallout. Instead, a gradual approach is being taken to manage the issue. However, given the scale of China's real estate bubble, this slow resolution could take decades, continuously weighing down banks. The scale of China's real estate crisis is so vast that it's often compared to Japan's bubble economy collapse, with many analysts predicting a worse outcome for China. Moreover, millions of Chinese citizens have experienced a relatively affluent lifestyle, and whether they will accept a decline in living standards remains an open question. Looking ahead to next year, We can expect further economic deterioration to exacerbate social unrest and highlight more systemic issues. I'll continue to monitor and report on these developments. Thank you for watching, and I'll see you in the next video.